Dear friends, welcome to the series of lectures on IC38 Life Insurance Agents exam. In this exam there are 50 questions and the duration of this exam is 60 minutes. Each question carries 1 mark and the pass marks are 18 marks. As per new syllabus there are 3 sections and 21 chapters. In section 1 there are 5 chapters, in section 2 11 chapters, in section 3 there are 5 chapters. So in section 1, introduction to insurance, customer service, grievance redressal mechanism, regulatory aspects of insurance agents, legal principles of an insurance contract, what life insurance involves. In section 2, financial planning, life insurance products 2, applications of life insurance, pricing and valuation in life insurance, documentation 1 and 2, then underwriting followed by payments under a life insurance policy. The third section deals with introduction to health insurance, documentation, insurance products, health insurance underwriting and claims. This is how these 3 sections are divided, and the expected marks from section 1 are 15 to 20 marks, and section 2 20 to 25, section 3 10 to 15. Dear friends, the details about this is given in another video of this previous section. In this video, we are going to learn in detail about introduction to insurance. Introduction to insurance. Chapter 1. What it says? Introduction to insurance. Dear friends, in this chapter, we are going to learn about introduction to the basics of insurance, evolution and how it works, how insurance provides protection against economic losses, how it serves as an instrument of risk transfer. These are all new terminology, but don't worry, you will be familiar with all this terminology. So it is taught in 5 sections, that is life insurance history and evolution, how insurance works, risk management techniques, insurance as a tool for managing risk, role of insurance in society. The introduction to insurance chapter deals with these 5 sections. Let us learn in detail. Dear friends, life insurance history and evolution. What is insurance? This is very important. In all exams it is asked. Right friends, insurance is risk transfer through risk pooling. Just remember what is risk transfer and risk pooling. We will explain. I will explain in next slides. So just remember that insurance is a risk transfer through risk pooling. Just remember like this. And in another way, it is very important. In all exams you will get this question. Insurance is a method of sharing the losses of a few by many, or many at the place of many they may write others also. So insurance is a method of sharing the losses of a few by many. Right friends? But as for definition of dictionary meaning, yes, provides protection against economic losses arising as a result of unforeseen events and serves as an instrument of risk transfer. Dear friends, don't worry about this dictionary meaning. Our exam point of view, insurance is risk transfer through risk pooling is correct answer. Insurance is a method of sharing the losses of a few by many. These are the 2 key points must remembered, so that you will get this question. If you get this question in exam, just blindly choose these answers. Right friends? So where it needed insurance, where we need insurance? Dear friends, events happening around us. What are the events are happening? Yes, there is a chance of fire, there is a chance of flood, there is a chance of earthquake, there is a chance of landslide, there is a chance of lightning. All these things, what they will do? These are all unpredictable, and what it will happen? They cause economic loss and grief. All these unpredictable things, they cause economic loss and grief, sorrow. So there is a huge loss and grief. So these are all the events where you need insurance. Then what is the history? Dear friends, it is not a new idea of taking insurance. So it has been practiced since 3000 BC onwards. Since 3000 BC it was practiced by Babylonian traders from Bharuch and Surat, that is Surat is from India, Greeks, inhabitants of Rhodes, and Chinese traders. Dear friends, here one important thing, Chinese traders, how they used to practice this insurance, do you know? So they used to practice, Chinese used to practice like this. So their goods are divided into so many ships. If something happens to any one ship, the loss incurred or the loss taken by the one trader is very minimum. That means there are 10 packets of goods. The 10 packets are shipped in 10 different ships. If something happens to one ship, the loss of the trader is only one packet. That is how they used to follow this technique to overcome losses. But what is the modern history? This is very important, friends. So modern Lloyd's, it is the place, Lloyd's coffee house in London. This is very important. Modern insurance business traced back to Lloyd's coffee house. Lloyd's is not a person's name. Lloyd's coffee house in London, where the traders used to gather there to take tea, and the traders those they gathered there were agreed to share the losses of their property, though that which is going to shipped. Means because of some pirates of ship or perils, something happens to any one ship, that loss has to be shared by all the traders. This is how they agreed at Lloyd's coffee house. This is very important. You can expect it definitely in your exam. Just remember Lloyd's, right? What it is? Next, Amicable Society for a Perpetual Assurance. It is the world's first life insurance company, which was found in 1706 in London. It is the world's first life insurance company. Let us come to our India. History of insurance in India. What is insurance? Yes, friends, modern insurance in India began in early 1800 or thereabouts. Dear friends, modern insurance in other countries or London, it was started in 1706, whereas in India it is started in 1800. So what it is? It began with agencies of foreign companies starting marine insurance business. It is obvious. During 18th century, who was the rulers of India? Britishers, that is foreigners. So the companies were started by these companies, that is foreign companies. The first life insurance company in India was English company, that is Oriental Life Insurance Company Limited. The first Indian non-life insurance company, Triton Insurance Company. The first Indian insurance company, Bombay Mutual Assurance Society Limited, which was found in 1870. Right, friends? And the oldest insurance company in India, which was started in 1906, was National Insurance Company Limited. These are all just details about the history of insurance in India. The question you can expect from this section is the modern insurance traced back to Lloyd's. The modern insurance traced back to Lloyd's. Lloyd's is key point, please remember. So remaining you may or may not get in your exam. This is how all I have given here to your understanding purpose. Next, in 1912, Life Insurance Companies Act and Provident Fund Act came into regulate the insurance business in India. So in 1912 there is a regulation started in India, insurance business, but all the companies are not following this. Some companies are following, some are not following. Then in 1938, Insurance Act came into power. First legislation enacted to regulate conduct of insurance companies. That means all insurance must follow this act, right? So there is a rules, there are some rules and regulations to run insurance business in India. This is the first stage where modern business started from 1938 with all regulations. Next, what happened in 1956? Till that time, there are so many businesses are going on. There are so many companies are running life insurance business. A company, B company, C company. There were around 175 companies or 200 companies were running at that time. So India got independence in 1947, 15th August. Whereas in 1956, Indian government taken a decision, nationalization of life insurance. Yes, they dissolved all the companies and made it into Life Insurance Corporation of India. On 1st September 1956, Life Insurance Corporation of India was founded, that is LIC was found in 1956 1st September, and it is the only authorized life insurance company in India from 1956 to 1999. Dear friends, this is the history of Life Insurance Corporation of India in India. So all the 200 companies which were there in India till that time were dissolved, and LIC was only the company which is allowed to do the business of life insurance. Yes friends, what else? In 1972, nationalization of non-life insurance. Dear friends, life insurance is nationalized in 1956, whereas non-life insurance is nationalized in 1972. Up to that time, there are about 35 to 40 companies were running under general insurance, that is generally non-life insurance, whereas in 1972 Government of India nationalized and the General Insurance Corporation of India was started with 4 subsidiary companies were set up. What else? Modern till date from 1993 to 2014. Yes friends, Insurance Regulatory and Development Authority of India. This is very very important. So in 1993 Malhotra Committee was set up. In 1993 Malhotra Committee was set up, and they submitted some proposals, some amendments to the Government of India. Based on that proposal and amendments, in 1997 Insurance Regulatory Authority was established. This is very important. In 1997 IRDA established. In April 2000 Insurance Regulatory and Development Authority was made as a statutory regulatory body both for life, non-life and health insurance industry. Means IRDA is the only regulatory body in India which governs life, non-life and health insurance. Dear friends, it is very simple to understand and remember. All banks works under the governance of Reserve Bank of India, RBI. In a similar way, all insurance companies works under IRDA, Insurance Regulatory and Development Authority. Dear friends, in 2014, IRDA has been subsequently renamed as IRDAI. This is how modern business started. Next, so the question is, among the following is the regulator for the insurance industry in India? Just now what I said, Insurance Authority of India? No. Who is the regulator? Insurance Regulatory and Development Authority of India is the regulator of insurance industry in India. Life Insurance Corporation of India? No. General Insurance Corporation of India? No. Answer is B. Insurance Regulatory and Development Authority of India is the correct answer. That means it is the only regulator for the insurance industry in India. It is a company or authority of India is the regulator for the insurance industry in India. What next? Dear friends, till now what we learned? Introduction to insurance, ancient and modern history of insurance companies in India and worldwide we completed. Then how insurance works. Let us see how insurance works. Dear friends, just now what I said, insurance is a process where losses of few are shared by many or others exposed to similar uncertain events or situations. This is very very key point. It is an arrangement involves the following entities like asset, risk, peril, contract, insurer and insured. What are all these things? Dear friends, please remember, asset, it must have some economic value, right? Physical, yes friends, if the car, if you want to take insurance, yes, you can take physically appearing car and it is having some economic value, so you can take insurance. Non-physical, dear friends, you can take non-physical insurance also. It is very very important. Name or goodwill. Do you know Kingfisher name itself is a worth of 10,000 crores, 10,000 crores rupees. So this is how non-physical also is considered as an asset. And personal, what is personal? Eyes or other body parts can be taken as an asset. You can insure, right friends? So this is how it must have some asset. Then what else? Risk. What is risk? Asset may lose value by certain events known as risk, and the cause of risk is known as peril. Peril may be natural or unnatural, right? So natural, maybe unnatural, accidental, whatever it is. So the cause of risk is known as peril. Dear friends, it is very very important. You can get on questions from this. What is asset? What is risk? What is peril? Pooling. When persons having similar assets exposed to similar risks contribute into a common pool of funds, it is known as pooling. Dear friends, it is very simple. So insurance company, so this organization which is done by is known as insurer. What they will do? Insurer, that is insurance company, what they will do? For example, all same age group people are pooled into one group, that is one block, right? So all same type of houses are taken into one group, right? All same type of cars are taken into one group, right? So all people, those whose income value is some value, so all they are kept in one group. That is how they pool. Similar, right? Contribute into a common pool of funds, it is known as similar assets. Means if someone is having some type of car, so the same type of car persons or the assets all pooled into one pool, that is pooling. And who will do this? Insurer, insurance company will do this. The insurer enters into an insurance contract. What is contract? So contract is an legal document or legal contract with each person who seeks to participate in the scheme. They has to undergo contract. Such a participation is known as insured. So how to get insured? So you have to take contract. Dear friends, insurance reduces burdens. If you take insurance, what it will give? It reduces burdens. What are the burdens? The costs, losses and disabilities one has to bear as a result of being exposed to a given loss or situation event. What it is? The costs, losses and disabilities one has to bear. It is all reduced, and it is two types. One is primary and secondary. What is primary risk? Dear friends, primary risk is it reduces primary risk. That means if something happened to your company or to your car, something happened to the insured thing, it is measurable and you will get the amount. This is clear, right? What is secondary burden of risk? Secondary burden of risk is if you do not take insurance and the things are uncertain, something may happen or may not happen. So this causes your mental strain, fear and anxiety. At the same time, what will you do? Suppose imagine you bought a car of 10 lakhs rupees and you don't have insurance. What will you do? You have to keep always 1 lakh rupees with you to, or minimum 1 lakh rupees to take care of your car repairs, because of some accidents may happen or may not happen. So by keeping this 1 lakh rupees as a liquid cash with you, that again causes strain and fear and anxiety. So this is how. So setting aside pool of money to encounter the future losses is known as secondary burden. Dear friends, it is very very clear. The liquid money without taking insurance, if you keep, that causes secondary burden of risk. It is asked in every exam. So secondary burden of risk is very clear, friends, right? So transferring the risk to an insurer, one can enjoy peace of mind. So what they will do? Insurance reduces burdens. How? By transferring the risk to an insurance, one can enjoy peace of mind. So if you want peace of mind, just take insurance. What is the process? For example, house owners contributing premium to insurance company, and if something happens, insurance companies will settle the claim, right? So this is how insurance works. Then just now what I said, which among the following is the secondary burden of risk? What it is? Business interruption cost? No. Goods damage cost? No. Setting aside reserves as a provision for meeting potential losses in the future. Just now what I said, 10 lakhs rupees car, setting aside 1 lakh rupees with you or liquid cash. This is secondary burden of risk, right? So hospitalization costs as a result of heart attack. So it is a secondary burden of risk. Most of the students, they will choose hospitalization, right? It is not correct. Which among the following is a secondary burden of risk is setting aside reserves as a provision for meeting potential losses in the future is known as secondary burden of risk. Yes friends, C is correct answer. Next, what is the next chapter? Next section, risk management techniques. What are the management techniques available? Yes friends, you have to manage risk. Dear friends, it is very important. You must remember all these 4 terminologies. Risk avoidance, right friends? Risk retention, risk reduction and control, right? Risk financing. Let us see one by one what it is. Risk avoidance, not doing anything, you are avoiding. So where is the business? Is this the good way to manage technique, manage the risk? No friends, it is a bad idea, right? So avoiding risk is not doing anything, is not a good management technique. Next one, risk retention. Dear friends, most of the people are following this, but that means self-insurance. If something happens, I will take care. Who will take care? Self. But really, if something happens, there is no one to take care. There is no one to take care. There is no one to save you. That is, risk retention is not a good idea. Then what else? Risk reduction and control. Risk reduction and control. What are the ways available? Risk reduction and control. Yes, you can reduce the risk by loss prevention. Reduce the chance of occurrence. What is loss prevention? You are preventing loss. That means chance of occurrence. For example, if you follow traffic rules, your loss will be prevented. That means chance of occurrence are reduced. Loss prevention says that reduce the chance of occurrence is known as loss prevention. For example, follow traffic rules. Loss reduction. Dear friends, these are key terms. Be clear. Loss reduction. Reduce degree of loss. Degree of loss. What does it mean? Right? If you follow traffic rules, there is chances are very less. Reduce degree of loss. Though something happened, you are following your traffic rules, but something happened, accident is taking place. Then loss reduction. How to reduce? If you wear a helmet or seat belt, the reduction, the degree of loss is less. So this is how you are reducing. What are the reduction methods? Education and training. Yes friends, you can educate yourself or you can educate your employees to fight against fire, right? To fight against unforeseen events, right friends? So training, yes, this is done by so many companies, like how to wear helmets and how to save yourself from unnatural things and natural things or accidents. What else? Risk financing. Dear friends, another thing is risk financing. Self-financing means some companies, what they will do as a small division, they depend on big major division or mother board of that companies. That is, so there is a small division is working here. If something happens, so main division will take care of the loss of this. So that is self-finance within that companies. But is this a good idea of managing techniques? No. So what else? Risk transfer. This is the only way. This is not only the way, but this is the best way. But this is the best way to enjoy the peace of mind by transferring your risk to your insurance company. It is one of the ways available to manage the risk by technically is taking insurance by risk transfer. Dear friends, what is risk transfer? Risk transfer is, insurance is one of the major forms of risk transfer. Means it permits uncertainty replaced by certainty through insurance indemnity. That means you can enjoy your peace of mind by transferring your risk to the insurance company. and you can concentrate in your business. That means you can develop your business. That is how by transferring the risk one can enjoy their peace of mind. This is very very important, friends. It is asked in so many times in this IC38 exam. By taking insurance one can enjoy the peace of mind is answer. Then you may have the doubt, what is insurance and assurance? Dear friends, there is a little difference. What it is? Insurance means the protection against an event that might happen, means there is a chance of happening. There is no guarantee that that will happen. That means, for example, if I take car, the accident may happen. There is no definite accident. Whereas in assurance, yes friends, if I take 100 cars, what is the percentage of getting accident? Say 10 to 30%. Okay. But if I take 100 people, what is the chance of death? Yes friends, 100%. Yes, all have to die at certain point. That means assurance protection given against an event that will happen definitely. That is death. So this is the difference between insurance and assurance. Insurance is given that incident may happen, whereas assurance that definitely is going to happen is given assurance. For example, insurance provides cover against a risk. Insurance works only if something happens. If something happens means if you have taken insurance to your car, that works only when something happens, right? Against a risk, when there is a risk, then only it will work. Whereas assurance, these policies are associated with life cover. We know that death is definitely is going to come, but this will continue till your life cover. It gives life, which is going to definitely happen. Still, assurance is given by insurance companies. This is how insurance and assurance are little different. So be clear, friends. Insurance is might happen, assurance is will happen. Means it is a little difference, right? How insurance indemnifies the insured, right friends? There are 4 steps. For example, step 1, individual has taken motor insurance. Yes, just now I said. So imagine something happened to the car and there is a individual meets with an accident. Let us see what happens. Step 3, what he will do? Individual makes a claim to insurance company. Then step 4, insurance company will give a new car or make a repair to your car. This is how insurance indemnifies the insured. Means the insured may be your car or yourself. So that is how your indemnifies the insurance. Next, the question, how it can be asked. Which among the following is a method of risk transfer? Just now what I said, risk transfer. Bank FD, are you going to transfer your risk? No. What else? Insurance. Dear friends, insurance is the only way of transferring your risk. Equity shares, are you going to transfer your risk? No. Then real estate, are you going to transfer your risk? No. The answer is B, that is insurance. Insurance is the method of risk transfer. Dear friends, this is how you can expect questions. Next, section D. Insurance as a tool for managing risk, a loss that is likely to occur. That means insurance as a tool for managing risk. What it is? A loss that is likely to occur. What it is? Probability. Right? So there must be some probability may happen leading to the loss. That means there is a chance of getting lost. Then only that what it will lead, that leads to loss. And impact, if the loss is high but probability is low. If the loss is high, dear friends, for example, building, right friends, building, if something happens, the loss is very high but probability of loss is very little. That is why the risk would be the premium will be the low, right? The risk would be low. That will happen, may happen. Insurance will be given to your house, but loss is very high, but the probability is very low. Whereas if you take life, may happen, right, leading to the loss. That is, if I take life, it is probability is very high. If I take car accident, probability is low, but may happen. So the probability, what you have to take care, before buying an insurance, before taking an insurance, you must think what is the probability of getting lost, what is the impact, means if loss is high but the probability is low, then the premium will be low, you can take it. Let us see what are the things to considerations before opting for insurance. What I mean to say, so what you have to think, don't risk a lot for a little. For example, you have a pen, and is it wise to taking insurance to your pen? No need to take insurance, because your pen costs around 5 to 100 rupees, no, not more than that, 100 rupees. Is it worth taking insurance to your pen? No. Don't risk more than what you can afford to lose, right friends? So if you are affordable, means if your pen is lost, is it not affordable? Yes friends, nothing will happen, it is affordable. So don't take insurance to your pen. What else? Consider the likely outcomes of the risk carefully. So just before taking insurance, if something happens, what will happen? Just think carefully, then take insurance. Otherwise, don't take. For example, pen, what I have taken. Example, if something happens, lost, nothing will happen. So when it comes to life, so think carefully. So consider the likely outcomes of the risk carefully. If something happens to the head of the family, what is going to happen? That is how you have to take insurance. What else? Which among the following scenarios warrants insurance? Just now what I am saying, when insurance is needed, the sole breadwinner of a family might die untimely. Dear friends, where it warrants insurance, you might have taken insurance. This is the situation. A person may lose his wallet. Stock prices may fall drastically. Yes? No? A house may lose value due to natural wear and tear. Which among the following scenarios warrants insurance? You may confuse from A and D. The sole breadwinner, a house may lose value due to natural wear and tear. Natural wear and tear, you cannot do insurance. If the sole breadwinner of a family might die untimely is the warrant, means answer A is correct. What is the role of insurance in society? Dear friends, section E deals with role of insurance in society. Their investments benefits the society at large. So, collected funds are held for the benefit of the policyholders. The funds are used for the policyholders' benefit, and direct and indirect benefits to the individual and country's economy. This insurance premiums will definitely benefit direct or indirect benefits to the individual and country's economy. Moreover, insurance removes the fear, worry and anxiety. These are all the positive things. Collateral security for loans on property. You can use your this insurance policy document as a collateral security for taking loans on property. And lower rates of premiums by arranging survey and inspection of the property. Yes friends. Next, what else? Your insurance companies are earning foreign exchange to the country by ensuring trade, shipping and travel. Dear friends, this is how your insurance company is going to take part in your country's economic development. Associated with fire, cargo, industrial and road safety. That means these are all the industries associated with insurance companies. That is how these many people are getting employed, and these many development schemes are running under insurance company. That means directly or indirectly your insurance company is taking part in the country's economic development. Right friends? What else? Insurance and social security. State and central government contribute premiums. Dear friends, as a statutory, that means compulsory, social security is an obligation of the state. Yes friends, state has to take care the social security. The Employees States Insurance Act in 1948, ESI came into power. That is Act 1948, the Employees State Insurance Act came into power. That means state and central government contribute premiums under Employees State Insurance Act. ESI is run by state and central government contribute premiums. Another government sponsored schemes are there. There are Rashtriya Krishi Bima Yojana, Rashtriya Swasthya Bima Yojana, Pradhana Mantri Jeevan Jyoti Bima Yojana, Pradhana Mantri Suraksha Bima Yojana. These are all 4 schemes sponsored by government. What else? Rural insurance schemes. Dear friends, rural insurance schemes provide social security to the rural families operated on a commercial basis. Rural insurance schemes are provided on social security to the rural families and operated on a commercial basis. What else? Insurance industry offers. Dear friends, there is a question always you can expect. Jan Arogya. The name shows it is a government scheme, but Jan Arogya is not a government scheme. It is a insurance company scheme. It is a private scheme. Jan Arogya is a private scheme. Insurance industry offers Janata Personal Accident. Janata Personal Accident. Yes friends, you can expect this question also. Janata Personal Accident is not a government scheme. Jan Arogya is not a government scheme. This is how you can expect questions in IC38 exam. Let us see which of the below insurance scheme is run by an insurer, not by government, and not sponsored by the government. What is Employees State Insurance Corporation? Dear friends, just now I said ESI is run by state and central government. Crop insurance scheme, yes, it is run by state and central government. Jan Arogya, just now I said Jan Arogya is the scheme run by insurer, not sponsored by the government. All of the above. Most of the people choose this D. D is wrong. A, B also wrong. Jan Arogya is run by insurer. Most of the people choose this D, but they get 0 marks. What it is? Answer is C. Jan Arogya is run by an insurer. It is not a government sponsored scheme. Dear friends, now we have learned about insurance is risk transfer through risk pooling. What I said at the beginning of this lesson. The origin of commercial insurance is traced to the Lloyd's Coffee House in London. This is very, very important friends. Lloyd's Coffee House. An insurance arrangement involves the following entities like asset, risk, peril, contract, insurer and insured. I have explained all these things. When persons having similar assets exposed to similar risks contribute into a common pool of funds, it is known as pooling. What is pooling? It's a similar assets exposed to similar risks. Apart from insurance, other risk management techniques include risk avoidance, risk control, retention, financing, and transfer. I'm sorry. The thumb rules of insurance. What are the thumb rules? Don't risk more than you can afford to lose. Consider the likely outcomes of the risk carefully and don't risk a lot for a little. These are the thumb rules. This is how the first chapter, Introduction to Insurance, is all about what is insurance, how it is started, what is the modern business in India, what is IRDAI, and what are the key terms involved in insurance industry, and what are the risk management techniques, economic developments done by insurance companies to the country. This is all about insurance, introduction to insurance. Dear friends, next chapter, customer service. Dear friends, customer service deals with importance of customer service, role of agents in providing service to customers, different grievances redressal mechanisms for insurance policy holders, how to communicate and relate with customer. These are all the key features of this chapter, and it is taught in different sections. That is under 6 sections: customer service, general concepts, insurance agents' role in providing great customer service, grievance redressal, communication process, non-verbal communication, ethical behavior. This is how you will learn in chapter 2. Here ends the chapter Introduction to Insurance. In next chapter 2 we will meet again. Dear friends, don't forget to subscribe my channel. Please share these videos to your friends, colleagues, give a like, and if you have any comments, please write. Click on bell button. Bye.